There are really two reasons to need capital. One reason is capital to fund growth, and that could be capital that is used for things that move over time and things that don't move over time. So things that move over time would be things like accounts receivable. As you grow, your accounts receivable grow, therefore you need cash to finance your customers, basically. You're lending money to your customers in the form of accounts receivable. So you got to get the money from somewhere. If you're growing fast, you've got this incredible cash need. And you go, wait, Jim, if I've got, people that owe me money, then I owe people money and that offsets. Well, yeah, but normally there's not enough of a spread. The spread is too far for one to pay for the other. You'll always need incremental capital to fund growth. So that's one. Accounts receivable being big one. Another one would be inventory. If you have inventory in your business, as you grow your business, you might in fact need capital to fund your inventory. That is fundamentally something that moves, hopefully. And then the last one would be maybe equipment and capital. Meaning capital equipment, machines, buildings, stuff that doesn't move. It's long-lived and you're going to need it to continue growing your business. But it's not something that flexes up and down based on how the business is doing. So let's talk about personal guarantees. This is one of the big deltas between an SBA loan and a non-SBA loan. When you go for a relatively unsecured loan, and generally they'll do it on multiples of cash flow. Now they'd love to have security, like if you don't pay us, we take your building. If you don't pay us, we take your inventory, which they don't like much. But let's say they just do it on cash flow. They'll say, look, you're making $1 million a year. We'll loan you $2 million against that. That's a pretty typical loan, okay? Generally, a bank will require you to do business with them if you're going to get a loan from them. And we want to see all your cash moving in and out of the account. So let's go to covenants for a minute, because that's going to be a really important point and an important point of negotiation when you start talking to the bank. They're going to, if you do it on a cash flow basis, so they're willing to loan you an amount based on the multiple of cash flow, no security, in other words, they're going to say, yeah, that's all good, but we need to make sure you stay healthy so you can pay us back. The other element that you can get from a bank is what they call an ABL. It's an asset-based line. Now, asset-based lines are secured. So the interest rate is lower. And because if things go south, they can go claim the asset that secures the loan. It's asset-based. And normally, they'll only lend a percentage of the value of the asset. Structural debt, asset-based lines, those are the two. And I think you really have to look hard at your seasonality and cyclicality of the business when you think about what's the right debt structure for you, right? If you are in oil and gas or in technology or in anything, let's say you're in things, the direct to consumer, where Q4 is the Christmas season, is always the biggest season, highly seasonal. You want to keep that debt level at your Q1, Q2 numbers, not your Q4 numbers, right? And you let the ABL float up, right, during the busy period and then float back down when you get out of the busy period. So that's the perfect use of structural debt and an ABL sitting on top of it to deal with your cyclicality. And the idea of mezzanine is when you think about the debt stack, first are the secured creditors, right? Then might come the bank debt, and then might come the unsecured creditors. So they're kind of risky, right? If things really go bad, they're like third in line to a whole bunch of other people, including the employees are actually first in a bankruptcy. Employees, then secured, then unsecured. And these guys might be third, right? So they have no security. So their interest rate's going to be high. There are another class, and I won't recommend doing business with these people, but there is another class of sort of rapid advance type players where they will lend you money in a day or two. And what they generally are looking at, like card flow, and they're focused on unbankable companies mostly, which most of you don't fall in that category. And they go, here's the deal. We're going to lend you $40,000. You got to pay us back $80,000. And what we're going to do is we're going to put a new credit card system in, and every credit card swipe you take, we're going to take 10% of it to pay down your loan. If you have a bank, you're going to have to report quarterly. You're going to have nice, tidy financials. You have to sit down with them every so often and tell them how your business is doing. The good news is they're not on your board. They won't be on your board because that would conflict them, but you will have to answer to them. So you now have a partner in the business, even though it's debt, right? All right. Just for, let me give you one last element. There is an option to go to friends and family, right? So you say, look, I need 100 or 200 or $300,000. I got a rich uncle. I can borrow the money from my rich uncle. All good. And you will be able to offer your rich uncle an interest rate that's very attractive to you, but there are lower limits on how much you can charge for interest. And they're called the applicable fund rates, AFR. You can look it up. And at the moment, the applicable fund rate for a short-term loan is 0.2% interest. You can charge as low as 0.2% interest for an in and out loan. Middle term, 1%, long term, 2%. So you can borrow from friends and family super cheap if you can get it and not violate the law. So equity is people investing in your business. They then own a percentage of your company, right? Early days, that's seed capital, friends and family, most likely, rich uncle, grandma, whoever. And this is horrible, but you generally don't have highly sophisticated investors. So you can have very light kind of constrictions on yourself when raising money from friends and family. They'll give you the money because they like you, they believe in you, they believe in what you're doing. They're not going to be looking for control provisions or board seats or anything like that. They're like, hey, just kill it, do great, and make a lot of money, and make me some too, right? So friends and family is one thing you want to go to, but the next level is high net worth. And when you're doing your early rounds, you can raise $1 million to $2 million at a high net worth. And that's about the limit you can get to unless you got somebody really affluent. And generally, even at 2 million, it's a club. 4 people chipping in $500,000. You'll be rare to find somebody who's willing to stroke a $2 million check on a risky proposition, an early stage proposition. The thing to remember is there is no $5 million investor. So if you want to bring capital in your business for growth and you want to raise $5 million, there is no $5 million investor. Ultra high net worth is going to tap out at $1 million, 2 million, maybe 3 on the outside. Professional money funds really only get interested around 10. There are a few that'll do lower, but there's a lot of overhead and time and to do this deal. They don't want to put a small amount of money to work. They want to put a larger amount of money. So it is very, very rare to find a fund that will do a $5 million equity investment for growth. The other thing you'll see almost typically in preferred is a liquidation preference. And what this means is when we sell the company, I get my cash out first, and then I participate like common. So let's say I sold 10% of the company to my preferred investor for $1 million. I'm making that up, right? And we sell the company for $20 million. They get their $1 million off the top day one. Boom. There's now $19 million left, and they get their 10% of the company. They get 10% of the $19 million as well. So they get 1.9 plus $1 million, $2.9 million on their $1 million return, right? Now, a one times liquidation preference is actually a little uncommon. Most of the time, they're going to negotiate for higher than 1. A 1.5 liquidation preference, a 2 times liquidation preference. So what that means in my example is I put in $1 million, I own 10%. We sold the company for 20 million. I've got a 2 times liquidation preference. So I get $2 million, my million plus another million off the table. There's 18 left for everybody else. And I get my 10% of the 18 for another 1.8. So I make $3.8 million on the exit.